The financial world often moves at a glacial pace, bound by tradition and regulatory caution. Yet, on a seemingly ordinary day, Bank of America, one of the titans, sent a shockwave. Their internal classifications quietly changed. Certain cryptocurrencies would now be recognized as a cash equivalent. To outsiders, that sounds like jargon. To watchers of finance versus crypto, this was seismic. The ground is shifting. The definition of money is being rewritten. This move is a reversal of long-held skepticism. For years, the message was extreme caution. They warned about volatility. They warned about regulatory uncertainty. They warned about potential illicit use. Crypto was treated as speculative, a risky gamble. Now a major bank groups digital currency with US Treasury bills and commercial paper. To truly grasp the magnitude of Bank of America's decision, we must first understand the traditional view of cryptocurrencies held by the banking establishment. For over a decade, since the inception of Bitcoin, digital assets have been viewed with a potent mix of suspicion, fear, and outright hostility. They were labeled as tools for criminals and conduits for money laundering, digital tulips. Banks actively warned clients away, framing it as a lawless digital Wild West. Decentralization challenges a model built on trusted third parties. A permissionless, peer-to-peer value network looked like an existential threat. However, time and technology wait for no institution. The ecosystem grew, matured, and proved resilient. Blockchain delivered transparency and security. Major corporations invested billions. Developers shipped real-world dApps. Market caps swelled to trillions, too large to ignore. The conversation shifted from if to how institutions should adapt. Bank of America's policy shift marks a key pillar laying down its arms. From competitor to be quashed, to asset to be incorporated. The term cash equivalent sounds mundane, like something you'd find in the footnotes of a corporate financial report. But in finance, these two words carry immense weight. A cash equivalent is an asset considered almost as good as cash. It must be highly liquid, convertible within 90 days, and have very low risk of value change. Short-term government bonds, treasury bills, high-grade commercial paper, sitting right next to physical currency and reliability. Placing a cryptocurrency into this category is a profound statement of trust and stability. It invites treasuries, investors, and funds to reconsider risk, opening doors for more conservative capital. Most importantly, it reframes regulation. Not all cryptocurrencies are the same. Some warrant privileged treatment. The story of cryptocurrency is a remarkable journey of innovation that began in 2009 with Bitcoin, by the anonymous figure known as Satoshi Nakamoto. Born from the ashes of the 2008 financial crisis, Bitcoin was introduced as a peer-to-peer electronic cash system, purely digital, secured by cryptography, and not controlled by any single bank or government. Early on, it was the realm of cryptographers, cypherpunks, and tech enthusiasts. Bitcoin established blockchain, a distributed, public, transparent ledger. Altcoins emerged. Ethereum introduced smart contracts, code as agreements. The blockchain became a global, programmable computer for dApps. DeFi rebuilt finance without intermediaries. NFTs enabled digital ownership. Stablecoins reduced volatility for everyday use. By 2025, thousands of projects formed a vast, interconnected web of assets and protocols. From humble beginnings to institutional recognition, proof of a resilient, innovative idea whose time has come. To understand the full significance of Bank of America's crypto shift, we must place it within Web 3. Web 1 was read-only. Web 2 became interactive and corporate-controlled. Web 3 is decentralized and user-owned. Control moves from corporations back to users. Built on transparency, security, and user sovereignty. Data shifts from private servers to blockchains. Governance moves from CEOs to token-holding communities. You own digital assets, identity, and data managed through your wallet. Interact and transact without oversharing personal information. dApps already offer alternatives in browsing, social, storage, and finance. Cryptocurrencies power transactions, governance, and incentives. Recognizing crypto as cash equivalent validates the economic layer of Web 3. Amidst the vast crypto world, the Pi network takes a uniquely accessible, community-first approach. Launched in 2019 by Stanford PhDs, secure, scalable, and accessible to everyone. Pi lets users mine on phones without draining battery or data. Tens of millions of pioneers participate in growth and security. Pi built the community first, creating instant reach for dApps. The goal: a complete digital economy powered by Pi. Developer tools enable social, marketplaces, and financial dApps with immediate impact. Imagine owning your content, paying in Pi, and cutting fees, on the phone in your pocket. By making participation intuitive, Pi onboards first-time Web3 users at scale. It's not just tech. Pi is cultivating a more equitable digital society. Bank validation plus Pi's community is the starting gun for the next financial evolution. Bank of America's reclassification creates a perfect storm of opportunity. Critics doubted legitimacy, but a pillar now says a well-structured digital asset can be as reliable as cash. This blessing provides tailwinds, stability, wide distribution, and real-world utility. Pi's enormous KYC-verified user base and ready-made ecosystem invite partners seeking global reach. Payment systems need critical mass. Pi already has it. Not just wallets, real verified individuals ready to transact. Banks want solid tech and engaged users. Pi checks both boxes. From coffee to subscriptions, everyday Pi payments become more attainable as merchants add crypto options. Top-down validation meets grassroots adoption. True transformation happens here. The door is open. Millions of pioneers are ready to walk through it. Inclusive, efficient, user-empowered peer-to-peer payments come into focus. The shifts signaled by Bank of America and the rise of Pi are about reshaping our world. Decentralization, transparency, and user ownership ripple across industries. Decentralized marketplaces connect buyers and sellers directly, reducing costs and opening competition. Your wallet manages identity and permissions. Prove what's needed, nothing more. Log in, apply, even vote, privately and securely. Immutable supply chains ensure authenticity and deter counterfeits. Patients control records and grant access. More secure, more efficient. Blockchain voting offers transparency, security, and auditable counts, boosting trust. This is bigger than payments or investments. It re-architects society's trust layer. More efficient, more transparent, more equitable, more secure. From finance to governments, a decentralized future returns power to the individual. We stand at a pivotal moment, witnessing the dawn of a new financial age. Bank of America recognizing a cryptocurrency as a cash equivalent is far more than accounting. It's symbolic. Banks will evolve, becoming bridges and gateways between fiat and Web3. Projects like Pi embody Web3, building global access through the smartphone. Top-down acceptance meets bottom-up energy. Money, ownership, and trust are being rebuilt. Every transaction, every line of code, every new user, the new financial age has begun,